How about that GameStop, eh? Now, I'm not doing an explainer here today. I do have various thoughts, and the main thing, if you're interested, I think this is one of the funniest things ever to me. That said, there are a lot of explainers out there. I'm not going to do a detailed explainer. I am planning on doing a series of blog posts, and I think you can see what I've been writing my notes down, and I'll talk about those a little bit in this video, but I'm not going to spend a lot of time. I am, if it doesn't make me laugh, this episode at least makes me smile because I love a good financial disaster story, partly because I'm a teacher and I like to, have examples, especially real life examples to show to students, not just talking about theory. When you have something like this occur, it injects reality that a lot of the times we ignore when we talk about various things. So one of the main things I do want to talk about is a lot of people are taking a moral take to this, especially when they don't understand the details, is just a very weird reaction to me. Though, I do see people get very, very worked up with regards to moral outrage in finance for a variety of things, vulture funds and this, that, and the other. Given I work in the financial biz, I rarely get too worked up with regards to the morality of certain things. And the specific things here, like shorting stocks or doing puts, or even shorting more than 100% of stocks, or using leverage in finance, doesn't morally outrage me. The only thing that does piss me off. There's actually several things that do, but the only one really is when you have the decision makers, and this is not insider trading per se, but if you basically have politicians who trade in various options or just financial instruments, stocks, whatever, and then they are about to pass a law that is going to affect those stocks, and they know it ahead of time. Buying up call options on, say, Tesla, right before you are going to announce that the federal fleet's going to be all electric. Yeah, that's one where I get a bit pissed off because you're making money off of power that you weren't supposed to be doing it this way. But, it happens, and it's entirely legal because the people making these kind of decisions are also the people making the rules saying that it's legal that they do this. So you think about that. Anyway, so let me go down some of the things I want to talk about in my blog post to come. Hedge funds and day traders in terms of what are their investment horizons. It's kind of interesting. People get to, day traders is very risky. Oh, and actually I should point out, here's my t-shirt I'm wearing right now. Okay. The motto of the Society of Actuaries, by the way, is risk is opportunity. And actuaries, to a certain extent, are all about risk, but we're about quantifying risk. What's interesting is I do actually know a lot of gambling actuaries, but in general, actuaries don't bet the milk money. And I'll be writing about that in a bit. But here's the point. So day traders, they do, you do high frequency trading, you do things fairly rapidly. Obviously, they have a very short horizon for their positions, for the kinds of things they're doing. And that's what that subreddit, Wall Street Bets, is focused on. That is not a long-term investment club, as it were. That said, hedge funds, in my opinion, aren't really long-term investors either. I guess it depends on the specific strategy. There's lots of different strategies. Heck, you could just do a straight up, buying and selling stocks and call yourself a hedge fund. Okay, it's marketing to a certain extent. And yes, there's regulatory, this, that, and the other, but I'm not going to get into it right now. But, getting head up about day traders and then someone is doing it as a hedge fund and you are investing institutional money, it makes me wonder about the institutions that are giving money to these hedge funds. Yeah, and I'm talking about public pensions, Okay, so short versus long positions. So I'll be talking about that. How do you gain? How do you lose? Leverage. Leverage can kill, But what leverage really does is amplifies. It amplifies gains and it amplifies losses. Another aspect of this particular episode, martingale betting, or doubling down when you're losing, and gambler's ruin. To a certain extent, this would not have been getting such headlines if one of and this is also the game theory of playing chicken, and I can talk about that as well. Um, if one side blinked, and it's a lot easier for a hedge fund to blink than just a mob of bozos from the internet. That's just a bunch of people. You can get this one or a couple people to defect from their strategy. But for the hedge fund, you have one decision maker, and they decide whether they're going to keep their position or not. If you double down as that one decision maker against the internet horde, well, that will be interesting to see. That's not over yet, so let's see how that turns out. Operational risk is actually a big part of this. Robinhood, the trading site, shut down certain kinds of trades, and people are like, oh, collusion and blah, blah, blah. But actually digging into the details, there was an operational issue in that they could not complete trades given what the activity was. And this is one of the issues, and this comes up in hedging programs, and that should not be mistaken for hedge funds. It's a very different thing. But in variable annuities, insurers have to run hedging programs to hedge some of the equity-based guarantees they have in the options. And the problem can be, how often do you do trades, or how often do you check your positions when you're hedging? You obviously can't do it an infinite number of times. You really don't want to be doing like the high frequency trading kind of thing necessarily if the transaction costs are too high. Now, with transaction costs going down, people have been doing things more frequently, and that's, again, high frequency trading. That's generally not hedging programs. The issue is when you have high volatility, that tends to mean you have to do a lot of trades in these hedging programs. And a lot of times we don't think through as individuals. Like, I don't trade that often. It's just my trades are in my 401k. The money gets deposited each paycheck. It goes to a mutual fund, because that's what I do. And it just sits there, and I rebalance no more often than once a year. I actually did my own research, and rebalancing more than once a year really didn't get me much in terms of risk management. In fact, rebalancing once every 5 years was even better strategy. Given history, that doesn't mean, of course, it would work going forward. Something to think about. Efficient market hypothesis. Yeah, so no one really believes the strong form of the efficient, or a very strong form of the efficient market hypothesis. And that has to do with market prices reflecting, incorporating all the information, and you have your market value, and that's the fair value. Fair value is another issue. Obviously, that is not true, especially for a stock that has a lot of activity, or I should say not much activity, not much volume, and all it takes is a few people to really affect the price. No one really believes that it is. So there's various forms, like weak market hypothesis, and there's different forms. And I've mentioned this before. I believe in an extremely weak version of the efficient market hypothesis, and that's Mary Pat Campbell, cannot beat the market. All my investments currently are in either ETFs or mutual funds, and they're broad market. I don't even do, I'm trying to remember, maybe I have a real estate chunk, but it's generally like small cap, large cap, international, government debt, that kind of thing. So, I do balances between sectors, but I'm even not speculating about what direction those sectors are going to go. Don't bet the milk money. This puts to mind one of my favorite examples, which was, and I think it was swaps that Harvard endowment was invested in and was losing a lot of money in. It turned out later, I got the initial story wrong. And part of it is because, of course, the reporting on the story. Yeah, I mean, reporting in the financial markets tends to be pretty good because people, journalists specialize in that area and they really get to understand, or they get to know people who can explain to them what is going on. And then they are able to write about it. Not a problem with that. The issue was, yes, Harvard was losing money on these swaps, and I'm like, ha ha ha, you just had to take losses and this, that, and the other, and Harvard did something stupid and blame Larry Summers because he was involved in setting up this deal. And he was no longer in charge of it, by the way, when it was losing money. And later on, I found out what had happened was it was a real hedge. And I need to, again, distinguish between real hedge, where you're buying instruments to reduce your exposure to a certain risk. Okay, so you might hedge against a stock price going up or a stock price going down. And usually that doesn't mean you're speculating. So you can use options like calls and puts to hedge against price movements. You see this with futures and forwards and swaps and other things like that, that you're saying, well, I actually don't want to be exposed to a specific risk, so I'm going to use this hedging strategy. Well, Harvard evidently was going to undergo some kind of capital project, build a building or something, and they had set up the swap as a hedge for their financing costs. It turns out they didn't do that capital project, but they forgot to unwind the hedge at the same time, and that's that's kind of hedging 101, and that's real hedging, not hedge funds. Hedge funds is again leverage and all of that. Risk concentration, risk exposure. I mean, there are so many things. If you're a professor who teaches risk management, this is such a gold mine of all sorts of dimensions of risk in this episode. And this is why I'm enjoying it. Also because I'm thinking I'm not exposed to all of this activity, but I might be. And that comes to my last topic that I'll be writing about. So I'm not discussing all of these right now, but these are things I will be writing over the next couple weeks or maybe months, depending on how long it takes for this thing to work itself out. It may take months. We're waiting for the lawsuits have already begun. Congressional hearings are sure to arrive at some point. But the last item is the principal agent problem, because it's not clear to me who invests with that hedge fund or hedge funds that have been exposed in the situation. At least with the Robinhood accounts, at least with the Wall Street bet people, they're just betting with their own money. They're speculating, they're gambling. But a lot of these hedge funds, of course, have institutional funds, public pension funds, and other things like that. So what if, the New York State, and I don't think so, but what if the New York State had money invested with them? Or Connecticut. I could see Connecticut doing this. It's some of the names that we've seen involved in the current spate are definitely hedge funds that have pension fund clients. And if they have to absorb the losses, this is the thing. Who ultimately will absorb the losses? Taxpayers, right? In some of the cases, not New York State, but Connecticut, the pension funds are so grossly underfunded, it may not only be the taxpayers who have to absorb the loss. So, something to think about. And I'll be writing about this. This is, writers love to have more material to write about.